A slew of regulatory crackdowns has shaped market sentiment for Chinese equities over the past year. On the heels of Ant Financial's cancelled public listing in late 2020, China moved to halt monopoly practices by tech firms, restrict gaming hours, ban private tutoring, and reduce debt in the property space. New rules on the overseas listing of Chinese firms sent technology stocks lower, pointing to another year of split fortunes for investors in Chinese equities.
Yeah, 2021 is extraordinary in a sense that the internet regulation has been tightening and affecting many of the platform companies' earnings and outlook. But then the damage is done in the offshore market.
The MSCI China Index, which tracks large and mid-cap Chinese equities listed onshore and offshore, fell more than 20% in 2021. In Hong Kong, where many Chinese firms are listed, the Hang Seng Index was the second worst performing index globally, posting a 14% decline for the year. In comparison, mainland bourses in Shanghai and Shenzhen saw modest gains. But overall, Chinese markets underperformed their global peers, which posted double-digit gains in the past year.
I still think that definitely the onshore will have a better time than the offshore investors in 2022. We continue to believe that China is a very, very investable market. From an index return perspective, maybe it will not be that spectacular, but if you're looking for sector specific or stock specific, then you could be looking at very good returns.
Last year, sectors like new energy, manufacturing and consumer plays attracted record foreign capital inflow into Chinese equities.
It was about 65 billion US dollars. So we're talking big numbers. That was really driven by China compared to most of the rest of the world handling the COVID outbreak quite well in terms of keeping case numbers down and keeping the economy more or less open. And so I think investors really looked at China as a safe haven.
Experts say growth in China's lower tier cities could fuel consumption growth going forward. And Chinese brands like Anta, Wuliangye and Li-Ning, which was the best performing stock in the Hang Seng Index last year, are among those likely to benefit.
You're going to see a lot of growth also in biotech in China. I think that's one area where the government has really emphasized a lot of investment right now. I think you're going to see probably actually in some sectors, like, for example, the apparel sector, some major Chinese brands actually now taking true leadership positions in the markets.
For 2022, the World Bank expects China's economy to ease to 5.1% after growth likely hit 8% last year. Amid the slowdown, BOCOM International says investors may be better off focusing on defensive sectors such as consumer staples, healthcare, and public utility. They can also start buying into beaten-down stocks listed in Hong Kong.
For the Hang Seng Index, but I would say that 22,000 is more or less the bottom. One should expect decent upside, 15% plus from there. For mainland Chinese market, though, it's probably 2-3% upside, but downside is bigger than the upside. Much of the monetary easing, will be going to support the economy, the real economy, instead of the financial economy.
Market headwinds such as China's zero-COVID policy and how it will reopen its borders, as well as the debt issue in the property space, could put pressure on markets. Risks arising from the US-China relations also loom on the horizon, but there could be some silver linings.
As the economy starts to slow down a little bit, you'll see a lot less heavy-handedness in terms of regulation and a much more pro-business growth stance. So more loans to small businesses, more support for key industries, and actually a less of the kind of regulation that should be of concern to an investor.
China is still committed to growing its economy, and it has a goal of doubling its economy by 2035. And along the way, it should surpass the US as well. And as its economy expands, we can expect earnings growth to rise in tandem which should lead to better share price performance.
So far, Chinese equities remain underweighted in key investor benchmarks. But attractive valuations plus the prospect of more companies listing on the mainland instead of overseas should attract investors.
The growth story is still here. I think investors just need to be a little bit more careful or more diversified in terms of their investment approach.
They should select investments within their risk tolerance. And also, the risk of investing in single stocks is higher, especially in emerging markets like China. And therefore, inexperienced investors, they may want to consider instruments such as ETFs or unit trusts for diversification.
If you just buy into a passive funds that is much more diversified, having both onshore and offshore, then you're probably going to have a very tight range of maybe high single digit to low teens kind of returns. But investing in a much more active funds probably can generate you probably in the mid teens to high teens kind of returns.